Okay, we're going to get started today by looking at the S&P 500. You can see from our chart that we are in an uptrend and we are following to a T the 20-day exponential moving average. We have the S&P above all of its moving averages. This is the 200, the 100, and the 50-day and the 20-day exponential moving average. And we're overbought still. So So right now, we're approaching one of the seasonality wise, one of the worst months of the year. Um, so be ready for some volatility because we also have a large amount of volatility in the month of September. Volatility means going up, going down, a lot of movement in stock prices. So um, let's look. Okay, so basically the way the S&P is going right now, it's hugging this 20-day exponential moving average. And as long as it stays above that, then we're still going to be going up in an uptrend, it seems. We do have news like tariff announcements coming out every day. On Friday, we had a tariff announcement that was all of Trump's tariffs were invalid. And we don't know we don't know what's going to happen with tariffs. And in general, when you're investing, you have to keep that kind of out of your investing equation because it's kind of you don't know what's going on there. All right, so let's look at some of our talking points. All right, so we have okay, we're coming into September. We have a holiday on Monday, the 1st, and usually stocks stocks are do good around the holidays. So let's see if that we have a um, good day on Tuesday. But we have the Fed meeting in the middle of September, and there should be some market volatility around that time. Also, we have Triple Witching Day, which is the third Thursday, third Friday of the month. So we're going to have a lot of volatility that day. So expect um, stocks to go up and down a lot. And on the 30th, we have end of quarter window dressing. So for the remainder of September, we'll probably have um, mutual funds, money managers moving into stocks that did good for this quarter right here. So those are the things we have to look forward to, but we don't have earnings really coming out in September. So there's the only things that we can have for this is why September is typically one of the worst months. We don't have earnings to drop kick our stocks higher. October is traditionally a decent month, although there have been some crashes that happened in October. Um, on average, it comes out. Let's look at our percentages. It's usually up 2%. So it's one of the best months of the year. No, 1%. So then we have December and November, December are typically good months too. So let's look at some of what happened this week. We had NVIDIA come out with earnings. They had a beat and raise quarter, which typically is good, but there were some people that were expecting a little bit more, and the stock went down like 3% after towards the end of the week here. So Snowflake had a really good earnings report. They went up a lot, and CrowdStrike they went down some because they're kind of overpriced right now. They're growing at 30%, but their PE ratio is like 130, so they're super pricey right now. And if they don't meet their numbers or exceed the expectations, they're going to go down. So Marvell came out with their earnings on Thursday, and they disappointed, and then the stock went down like 20%. And Dell also came out with earnings, and they disappointed, and their stock went down also like 5 or 6%. So that's about the end of the earnings season. We have next week we have a couple stragglers companies that aren't that important coming out with earnings. We have Zscaler, that's a cybersecurity company. We have Salesforce, which is much less of an important stock these days. There's some stocks in the software sector that are getting displaced by AI, it seems, like Adobe, Salesforce. Um, so that Salesforce is going down a lot recently. They have a high peg ratio, so I've kind of never been interested in that one. Okay, HPE, they do computer systems, and Broadcom is probably the most important for this whole week because they're involved with AI. Um, they also have a certain portion of their revenue coming from VMware, or no, they do software for like half of their earnings. So we're going to find out a little bit more about the AI um, trade when we listen to Broadcom's information on Thursday. So that's about it. After this, we got to wait a whole month for earnings to come in again. Okay, we don't have a whole lot of movement in our treasuries. Let's look at a chart for the treasuries. You can see that in general, treasuries have been going down. And as treasuries go down in yield, the S&P goes up. So this week we had it where the yields have gone up and the S&P has gone down. So we do have an inverse correlation. Um, that's probably because the if there's a guaranteed yield that that pays more, then people will not want to put money in a risky investment. So in other words, if stocks return 9% on average, and they had a risk factor involved with them where they can go up and down 20%, and if you had a US Treasury yielding 10%, then people will definitely buy the US Treasury because it's more of a guarantee and less risk. So that's the idea. So far that theory is kind of coming to fruition here. Okay, let's look at the price of oil is kind of staying around the same price, maybe up 1%. Inflation is staying at 2.7%. We have gold up just a little bit this week, and US dollar isn't is kind of unchanged this week, but it is still in a downtrend, the dollar. So usually when the dollar goes down, material commodity prices go up because commodities are priced in US dollars, but we don't have that one-to-one correlation for some reason. I don't know why. Usually if the dollar goes down 10% in a year like it has this year, you would think that the price of oil goes up, the price of gold goes up, the price of any commodity would tend to go up. But there isn't necessarily that correlation yet. Okay, let's look at the fear and greed index. We have greed in the market right now. So translation is take some profits off the table or don't buy. Okay, so we have the AAII Individual Investor Survey, amateur, and we see that most are bearish right now, which is kind of opposite our fear greed index. So so we have the amateur investor kind of scared where things are going right now. So the opposite of that is time to buy. So we have two conflicting indicators. So we have to wait to see which one of this is true. VIX remains very low, so we don't have a whole lot of fear in the market right now. Um, so I would say we're in a delusional greed part of the market right now. We do have stocks trading at extended valuations. People are excited and they're bidding up AI stocks and worthless meme stocks. So we do have that delusion in the market right now. So I would put where we are right here. Um, all right. And Okay, P ratio right now for the S&P is 25. And that corresponds to some of the highest valuations we've had of all time, basically. And the times that we've had similar valuations, we've had crashes like in 1920, in the year 2000. Um, so we do have a situation where the stock market is overextended right now. So it's about 20% overvalued. So just keep that in mind. And a lot of times stocks revert to the mean. Let's look at our first to worst. At the beginning of this year, last year we had communication services, IT, and consumer discretionary up the most, over 30%. This year, our best performing sectors are communication services. Number two is industrials. And number three is IT. And number four is materials. Materials was the worst last year. So we'll keep an eye on this, but it seems like what's happening in the past week or two, we've had a lot of movement from some of the higher valuation IT related companies to sectors that are undervalued. So if we look at our, see, let's look at our valuation chart. Hold on, it'll be worth it. Here it is. Okay, you can see that IT right now is in the 90th percentile, meaning it's super expensive compared to prior times in the last how many years. And the most inexpensive compared to history is energy, financials, healthcare, real estate, utilities. So what's happening recently is we're having stocks moving from IT, consumer discretionary, to stocks that are undervalued, such as energy, financials, healthcare, real estate, utilities. So the reason why you got to keep that in mind is these stocks right here, the ITs, consumer discretionary industrials, they have a tendency to grow faster, so they command a higher premium in general. But right now they are selling at a super premium. And we've had a movement towards some of the undervalued sectors. So this might continue as we approach one of the seasonally worst months of the year. So every day we'll be looking for this rotation, and we'll see in our top 10 ups and downs today that it seems like on Friday we had this movement from IT to some of the more undervalued sectors. Okay, so let's continue. Where were we? Okay. Okay, let's look at some of our stocks going up and down. And we'll keep in mind this chart here. Okay, US stock movers. Okay, so you can see some of the best performing stocks are some of the more conservative stocks that have not performed well this year. Brown-Forman, they sell spam. I mean, no, they sell liquor, so they're very conservative. These are food and let me see, food companies, healthcare, United Health. Food. Well, Lamb Weston, they make French fries. Okay, so we have a lot of food companies here. These are very conservative companies. They have not participated in the rally this year at all. Most of these are down for the year. So we have a movement from, and now look at these ones that are top decliners. Dell, they had bad earnings. Ulta Beauty, Oracle, Supermicro, Exxon Enterprise, all these have super high egg ratios and they're high PE ratios also. And they've done really well this year so far. So they're basically, so we've had this, let's look at this. chart while we're looking at that. You can see that the ones going up the most, the Autodesk, you see Jim Smucker, healthcare, or in this healthcare real estate financials. Um, consumer staples is kind of what that is. So consumer staples and the top decliners are the ones that are higher valued. So over time, stocks will have a tendency to balance out. So right now, the IT sector is kind of overvalued and extended. So we might see more of this continuing. That doesn't mean you don't own the IT sector. IT sector is probably growing 15 to 30% a year in their earnings, whereas the energy sector, they're only growing at 5% maybe or 10 at the most. So there's a reason why the IT sector commands a higher premium. All right, that was a good exercise. Let's look at the sectors going up and down the most. Okay, tech, these are high risk um, stocks and the high reward. The ones going down up the most are conservative stocks. We have gold. Gold is a very conservative investment. Um, real estate, energy, materials. Okay, healthcare. So this healthcare, energy, real estate, utilities. Okay, that's what happened. Basically, people are rotating out of some of the better performing stocks from this year to the undervalued sectors. Okay, that was a good exercise. Okay, so let's look at Dan Now's picks from the beginning of the year. KBWB is his best pick. It is up 18%. These are the large banks, such as Bank of America, Wells Fargo, and JP Morgan, Goldman Sachs. 18%, amazing. An index could be up that much. Cisco is up 17%. ADTN, another networking play, is up 12%. IJJ is only up 4%. That's the mid-cap ETF. Cash, that probably wasn't a good one. Having cash the whole year isn't a great idea, but maybe to participate in the crash in April, that probably would have helped there. All right, so now let's look at some charts that I found interesting. You can see that healthcare, one of the worst sectors we saw so far this year, um, is kind of right at a crossroads. We're in this downward channel, yet we're starting this sideways pattern here too. So we're right at the edge of the downward channel, and we're kind of almost thinking about breaking out of that. So if we do, we'll end up in this sideways pattern like this. This is a pattern that a lot of the dividend paying stocks follow. But you can see it's a little overvalued right now. It's overbought right now. So stochastics are pretty high. But we're going to watch this and see if it breaks out of this downtrend because this is the healthcare ETF. And if there is some problems in the stock market in the seasonally bad month of September, maybe people will be buying the healthcare sector, which is a little bit more fairly valued. All right, let's look at the next one. Next one is consumer staples sector, XLP. You can see we're in a sideways pattern here. This is very similar to some of the dividend stocks we follow. You can see we're oversold right now, and we're at the bottom end of this trading range. So it seems like um, consumer staples are a very conservative sector, and they haven't done anything this year. You can see they're sideways for a whole year. But in times when everyone is selling some of the high flying and overvalued stocks, um, market participants might want to buy a more conservative sector that pay dividends. So let me do one search here. Okay, so let's look at some of these stocks that are part of that XLP, consumer staples sector. Walmart, Costco, Procter& and Gamble, Coca-Cola, Philip Morris, Pepsi, Altria, Mondelez, uh, Colgate Palmolive, and Target. You can see they all pay a dividend, and they're all relatively have been out of favor for 2 years or more. So perhaps, I guess the only one doing well out of this whole group is Altria. They're up this year, and Walmart has been doing good too. So perhaps people might be rotating into these kind of stocks as there's volatility in the stock market. We'll see. Right. So let's look at this is the ITB, U.S. Home Construction iShares. We saw that this sector has been in a downtrend. It broke out of this downtrend right around the beginning of July. And you can see it's in an uptrend now. It's going to be helped by lower interest rates. We know the Fed is going to be lowering interest rates, and the president is pushing for a lower interest rate. So that is going to happen. And we can see that this is the new breakout sector for that's replacing some of the other sectors like the tech sector that was doing so well this year. Um, so we'll follow this home construction ETF along with some of the stocks in that index. Let's look at some of the stocks in that index while we're at it. ITB, top. Okay, let's look at the top holdings. DR Horton, Lennar, Pulte Group, NVR, Toll Group. There's only like 10 home building companies in America. So these are the ones right here. Every one of these has been in a downtrend forever, and it's for a couple years, and they're finally starting to they're up 20% from the bottom of this year. Um, so let's keep an eye on that sector. Okay, Walmart. Walmart. This is one of the stocks in the consumer staple sector. It's a very conservative stock. You can see it's oversold right now. It's stochastics are at a 7. That is pretty low. And you can see it's at the bottom end of its trading range. These are the trend lines that I drew, and at the bottom end. So as there's volatility in the stock market, people may be trending towards stocks that are a little bit more conservative, like this one. Let's look at the next one, NVIDIA. You can see this uptrend we've had for quite a while since the lows in April. We broke out of this uptrend recently, and I think it was, and you can see we're starting this new kind of sideways to downtrend. So we had earnings come out for NVIDIA this week, and um, they beat and raised their guidance for next year, and they're growing around 50%, um, which is amazing for this kind of sized company. But it wasn't as good as they expected for some of the data center revenues. So they disappointed like a very small amount. And because of that, people were taking the opportunity to sell this one. Now you can see whenever a stock goes up like this and we start this sideways pattern, we look at the moving averages for support. So we're approaching the 50-day moving average like right here. So if we don't hold at that 50-day moving average, the next level of support is way down here. which is at $138 a share. That's the 200-day moving average. So let's hope that we have this stock continue its uptrend, which is like right here and here. Okay, we don't know what's going to happen there, but this is one of the leaders of the stock market. If this stock starts selling off for some reason, the market will follow it most likely. So this is a very important stock to watch. And this pattern right here was broken right there. Um, so those that are momentum investors saw this break right here, and they would sell some of their position because we don't know what's going to happen next. If it does go back into this uptrend, then um, the bull market for the stock is still intact. But we will see. It's still a little bit overbought in the stochastics, but it's going down. All right, so let's look at the next one. JP Morgan. The financials are on a tear this year. They're all up. You saw by the banking ETF that Dan Niles chose. It's up 18%. And JP Morgan is one of the leaders of the banks. It's the largest and best capitalized and best, it's run the best also. So it's overbought right now, but it's still one of the strongest stocks in the stock market. You can see this 50-day exponential moving average, this red line here. It's very important. It's hugging that line. And you can see that right now, this stock is continuing in an uptrend. It has some very positive reasons to continue because of the help from this current administration and lowering interest rates. There's a lot of um, good news for banks, and there's deregulation also coming around the bend. All right, so I had a stock screen for this week, and just a note, I had the green. Um, we have different different things we look for. Let's look at the okay. Okay, so I have some stocks that were above average in a lot of their categories. We have a stock called App 11. It's a smaller stock, and it says it's on sale, and it's growing around 50 or more percent. Has a high return on equity, so we're going to look at that one. And okay, this is App, isn't it? It's a symbol, App 11. You can see it's growing at around 50%, 48% a year from this year to next year. And its PE ratio is 78, so it's a pretty high PE. So its PEG ratio, if you divide 78 by 48, its growth rate, it's 1.6. So it's around 1.6 times overvalued. Its profit margin is 42%, which is amazing. So they're very profitable. They return on equity of 253. That is like that's like 20 times what we're looking for. So they're a very efficient company. They're just trading at a higher multiple right now. Let's look at their chart. You can see they're at the top end of their trading range. These are the trend lines that I drew. So it's definitely, this is probably the worst time to buy this stock. It's overbought and it's at the top end of its trading range. Let's wait for it to go down to here before we start looking to buy it. And okay, so that was it's overvalued right now. Perhaps this is the kind of stock where if it's overvalued by 1.6 times in a really bad market, it'll trade down to a PEG ratio of 1. So if you divide the current price by 1.6, you see what's current price is 480. Let's do that calculation. 480 divided by 1.6, 300. When it gets down to $300 a share, which is right here, then it'll be fairly valued. So I'll look at it around there. And it actually, during the April time, whenever there were tariffs and everyone was scared, it basically went down to a peg ratio of 1. So whenever there is insanity in the stock market and chaos, you can always rely on the peg ratio to really point to you how much something's really worth. And so if you can see this 200-day moving average right here, you can see that the it held support right there. So in a really bad market, it might go down to 346. So we'll watch for it. It's a smaller stock, so it could be very volatile. So we'll watch for it to go down if it ever it sells at a premium. It's always sold at a premium, but we'll see what happens with this one. I thought it'd be interesting um, to go over contra funds changes in their holdings. They just came out for the time period ending in July. I'm comparing that. No, this is actually July of 2023. Um, this is July of 2025. I thought it'd be interesting to compare um, 2 years ago against now and what stocks were added and removed. You can see that Meta has grown from 11% to 17.55%. Partially that's because Meta has gone up, appreciated a lot. Um, but this mutual fund actually chose to continue to hold the stock. So 17% into one stock is that's a check of approval for that stock. NVIDIA has gone up from, let me see, 3%, 3.8% in 2 years ago to 9.5% this year. Every other, let's look at the ones that were added. Netflix and Amphenol were added. We're going to go over those now just because it'd be interesting to look at these stocks. And Apple and Eli Lilly were reduced almost in half from what they were 2 years ago. Right. So let's look at Netflix and Amphenol. Right. So Netflix. You can see this is one of the strongest stocks in the stock market right now. Um, the talking heads on TV say that um, it's recession resistant because it's only $20 a month, and it's really hard to get entertainment at $20 a month. So, and in good times and bad, people are going to continue to renew their subscription. And the great thing about Netflix is they invested a lot into content for the past how many years of their existence, and now they can show reruns basically to their clients, and it won't. There's no cost for that really. So they're spending a lot for content still, but they're becoming more efficient over time. So you can see that they're in an uptrend. They're towards the bottom end of their trading channel that I drew, and they're about halfway between overbought and oversold. You can see that early at the beginning of August, they were oversold right here. See, they're oversold and they went down to the bottom of the trend line. So they have a little bit more to go. Maybe this downtrend in September will get us down to the bottom end of this trading range. Maybe, and then we get oversold. That'll be a better time to buy it. We're kind of right in the middle in no man's land right now. All right, so let's look at the statistics for Netflix. The market cap is half a trillion. We have forward PE of 47, which is really high, but they've always commanded a high premium. Their PEG ratio, according to Yahoo Finance, is 1.6. Their profit margin is double what we're looking for, 24. And return on equity is 4 times what we're looking for at 43. So very efficient and a very profitable company. Their total debt is 16 billion and their total cash is 8 billion. So they only have 8 billion of debt out of 513, and that's very manageable. That's like negligible. That's a rounding error. They have levered free cash flow of 22 billion, and that means they're profitable. So they're growing at 22%, 23%, and their PE ratio is 47. So their PEG ratio, you divide 47 by 23, and that's around 2. So they're 2 times overvalued right now. Let's look at their chart in whenever we had that break in April. It went down to 900. So, okay, so basically it went to a PEG ratio of like 1.5 right here. So in a really bad market, a good quality stock will go down to a PEG ratio of 1. And that's a good time to start buying that. But let's look at, let's look at, um, okay, Amphenol. This is a company that makes, they make a lot of the equipment for AI data centers right now, and that's why they've gone up exponentially this year. You can see that this is very similar to the chart of NVIDIA. It's an AI play, and let's look at, you can see they're in an uptrend right now, and they're right at their 20-day exponential moving average. So very similar to some of the growth stocks we're following. It's hugging this 20-day exponential moving average. So as long as it's above that average, we're going to continue to go up. But if it breaks it, um, then there's some people might want to sell out of that maybe. All right, but we're still above the 50-day moving average, 200-day and 150 days. So it does have a lot of momentum, but it's over right now. It's um, stochastics are pretty high. They're 73, so they're overbought. So let's look at their statistics. Well, first of all, let's look at what this company does. Um, they design, manufacture, and market electrical, electronic, and fiber optic connectors in the United States, China, and internationally. So these are the fiber optic connectors that are needed in an AI data center. So they get a lot of business from that. So fiber optic, so that's what they do. So let's look at their market cap. It's 132 billion. Their forward PE is 36 and their PEG ratio is 2. So I did the statistics, their estimates for the future, and it seems like they're growing at 11.5. So if they say it's 11, and their PE ratio is 37. So that means they're 3 times overvalued. So this is a very dangerous stock to buy right now. Their numbers are really good. Their profit margin is right where we're looking for. It's 16. Their return on equity is 31. Total cash, they have 5 billion in debt out of 132. That is very small. It's negligible. And the free cash flow is 1.8 billion, which is good. They're profitable. So this is an AI story. They're running up um, with the AI stocks. If there is a hint, like we had a hint of the NVIDIA didn't meet some expectations, we have to watch this because if it breaks this uptrend and if it breaks this 20-day exponential moving average, it might go down to maybe its fair value, which is towards like down here. All right, so that's a very dangerous stock to have right now. Okay, I highlighted all the stocks that are currently holding Netflix, all the mutual funds. So we have a majority of our mutual funds that are the largest in the country are holding Netflix. So that's a good check of approval, but they are overvalued. Okay, well, all right, that's all I had to say for today. I hope you enjoyed the talk, and I'll see you next time.